It is FOMC Eve. We have the latest jobs data coming in. The markets are a little apprehensive as we wait for the news tomorrow, as well as plenty of earnings. We'll be discussing all of that and more today on Money Never Sleeps. Welcome back, everybody, to Money Never Sleeps. As we get going, do us a favor, hit that like button, subscribe to our channel. Nothing Kevin or I say is financial advice, so please do your own research before making any buys or sells. Kev, we're in the thick of it this week. We got tech earnings, we got economic data, we got the FOMC tomorrow. How are you feeling today? We'll keep it on the shorter side because we're waiting for so much. It's a waiting game right now. The markets are kind of sitting here waiting, unsure of what direction they want to go in. It's been up, it's been down. We're relatively flat at the moment. But how are you feeling heading into the first FOMC decision of the year and a huge day of earnings?
I'm kind of scared in the short term because I know how irrational markets can be and how they just always try and price everything in way ahead of time. However, I still think that they're not pricing in arguably some of the biggest things that they should be pricing in. So I think it's going to be really interesting seeing how the bond market reacts to whatever Powell says tomorrow, because that's going to kind of give you an idea of what the trajectory of the reversion looks like, and also pretty much if they're going to be cutting rates sooner rather than later. I also think that the dollar and gold are going to have a really wild day tomorrow. Other than that, in terms of everything that we've kind of gotten yesterday and today, and even a little bit last week, I feel pretty confident that we're not heading for a soft landing. Um, you and I talked about this yesterday when we were looking at some of the earnings ahead this week. UPS was no different than what FedEx had already forecasted back in December, right? It seems like the labor market, even though the JOLTS report's saying one thing, it's like the private economy, the private market, is pretty much telling us that there's some layoffs here where we need to cut some costs. It's cost saving job cuts.
Okay. Cost saving job cuts. Yeah, we saw the UPS news. We have earnings later, here in the next couple of hours that will be coming out from, let me see here. We got again, right, Tab, Microsoft, Alphabet, AMD, Starbucks. So it's a big one today before the Fed meeting. Crypto has been relatively positive on the day. Altcoins are kind of leading the charge. Link, Solana, they have they've seen a nice little run up. Not really sure what is driving it at the moment. If we look at the rest of the market, especially in tech, we're seeing Nvidia, small gain on the day, which I know must just be eating at you, Kevin, the constant Nvidia hater. Um, Meta's, is fractionally up on the day. Tesla a little bit. Seeing Netflix pulling back. I have started to see more and more discussion around this bubble that could be forming with the top 10 stocks. You brought it up yesterday when it came to the Russell, and people are starting to come around to the idea that maybe this is a bubble that looks a lot like 2000 in regards to how much of the market cap for the entire stock market is concentrated in these 10 companies. I think right now it's around 29.5%, which is wild compared to, the high of around 33% for the biggest companies back in 2000. So maybe we're starting to see something there. I'd be lying if I said I wasn't considering selling the bulk of my Nvidia at this price, because it's like it's been a great return. I don't know how the legs it really has on it for at least the next year or two. And I'm not trying to time the market, but do I think I have the opportunity to buy back in at a much lower price? Potentially. That's kind of a decision I'm going to have to make on my own there. But it feels like we're in a standoff right now. Like no one knows. Everyone's like has their position, and for the most part, they're like kind of. It feels like a lot of people could be flipped to the other side at the drop of a hat right now, except for you, who I know is just going to be bearish until the very bottom.
Yeah, it's because I have balls and I'm willing to sit in my fucking positions and say
These
what
hands.
these hands, diamond hands, balls of steel. That's the two things. That's what makes you and I special on the internet. But I think right now it's the two extremes, right? I think you're getting assholes on CNBC who are saying like, well, it could happen. They're never going to tell you one way or the other how they're positioned, right? They're not going to tell you that there's a good chance we're going to get a crash, or they're not saying that we're not going to see a crash. We're going to continue rallying up forever. More likely they're going to say that than opposed to the crash. But for the most part, they're really playing this, very, very, even how I'm even trying to say this, very carefully, to the point where they don't want to say too much, but at the same time they don't want to shoot themselves maybe in the foot by being too one way or the other. I feel like a lot of people are apprehensive on TV right now. Given that, I think a lot of people out here are either so bullish that they're not pricing in anything bad ever happening. They're just, assuming that everything's going to go up forever. And you got people who are bearish who are just capitulating because it's like, well, I haven't been right yet. I can't continue to bleed out here. So it's a really interesting scenario where we are right now. And like you said, I think you brought up a great point. It's very similar to the tech .com bubble that we saw back in the early 2000s. I also think that because of how hit or miss we are right now, a crash is probably the most likely scenario. If anything bad were to happen, I think a crash is probably what we're going to see. We're not going to see a slow bleed out. The fact that the top tech stocks are the ones that are weighted the most in some of these indexes, any of those bleed, everything else is going to kind of get dragged down with it. It's no different than Bitcoin dominance, right? So I think that it's more likely we see a crash, like pretty good move to the downside, as opposed to any move that takes, a year or two or something like that to finally find a really good retracement where maybe you are able to buy stuff at a cheaper value. But right now, I can't buy into that we're in this bull market and that we're going to get the soft landing when the Fed's never pulled off a soft landing, and then we're starting to see fucking layoffs increase like crazy. That's something that we were waiting for, and we always said that the layoffs increase going into a recession, and then they also lead into the crash itself too. We saw that in 2008. So I'm really interested in seeing what happens, but I completely agree. This market doesn't know where it's going. I don't even know where it's going, but I can tell you that I've done the research, and all signs are pointing towards hell.
We're on a highway to hell right there. Great song, not the most fun destination. Okay, we got the JOLTS report earlier today that showed like 9 million job openings. It came in higher than expected. I don't even know what, like,
I know
we can
why.
we can bring these numbers up, but like none of them feel like they're worth a damn and they're actionable because they just keep getting revised. So what the fuck's the point?
Well, I mean, you and I both know what that number is, right? Those are all government jobs, right? I don't see anyone in the other than Chipotle who's decided they want to hire like 19,000 fucking people. Uh, there's no one in the
Well, they got to
corporate world.
shake. They got to, they need more people so that when they get your guacamole money, they can take you out back and shake you down for every cent you got. Because
That's
$5 for a little scoop of guacamole right there. I mean, what are we doing?
Chipotle. Chipotle
Chipotle's
needs
gone to shit. Let's be honest. The quality of their food is trash now. Like Chipotle used to be good back in the day, but I think it's all gone to hell in a handbasket. They're cutting back on cheaper ingredients and they keep raising the prices. I have a very strong stance on this, and I will not stand for it anymore.
tell that to their shareholders so they can help them out with my puts. But yeah, I completely agree. I think that right now with the Jolts and from Jolts data, a lot of it is coming down to positions that are opening for government positions, and again, those aren't necessarily showing signs of growth in an economy. Sure, there's money flowing because they obviously have money and they're contributing to the economy. However, it's not showing us strength like Tesla's hiring 500 people, right? PayPal's hiring 2,000 people. They're not. They're actually doing the opposite. We can go down the list with this. None of those companies are hiring. They're all laying people off. So if we're seeing job openings on the government side and that's what they're touting as like, look how strong we are. Well, that's kind of fucking misleading. So I don't buy it one bit. And I think the layoffs are the one thing that we need to keep an eye on more than anything.
Okay. Yeah, I would agree with you on that one. We get private sector data tomorrow, whatever. We get the FOMC decision. It's going to be another skip. They're not going to raise rates. They're not going to cut rates. What Jay Powell said is going to be what moves the markets the most. So we will be jumping on, after he is done speaking and kind of recapping that quickly. What else today is really, we didn't have any Evergrande news as far as I know. But what are you seeing in the markets right now that has your attention?
Yeah, I mean, you brought up Evergrande, so let's just go to China. We got one thing we got to check out. Nothing too crazy. We had a pretty bad day in China yesterday in terms of the stock market selling off. We're back under 16K. As fast as we got up there in the few days that they announced that liquidity pushing the market up, well, now we're starting to pull back down, right? We had a 373, almost 374 point day down. It's a pretty good move. Gap down was pretty nice, but it looks like it found resistance right here once again. And it's within this kind of like triangle. I don't think it's the greatest structure, so I mean I'll delete it, but it seems like this trend line right here just keeps hitting since November of 2023. So wherever that's finding resistance, so be it. I think it's going to be interesting to see how it plays over the next few days. We know that February 5th is going to be a big day for them as well because of the PBOC and some of those rate reductions that they're going to be doing. So I think that it'll be interesting seeing that. I know that they're increasing liquidity. The more they inject liquidity into the system, the worse it gets for them. So I honestly, at some point, it's going to be really complicated. And the other thing is, I didn't mention it yesterday, but we kind of touched on it, was, once they start repricing some of those assets in Evergrande, some of those commercial real estate loans, there's a good chance that a lot of those aren't worth as much as people thought they were. And that's going to definitely bring down the values of even the commercial real estate loans here in the United States, too. So that's going to be really interesting to see. And again, February leading into March, liquidity is going to be drained from the reverse repo. Bank term funding programs coming to an end. Now we got this commercial real estate loans that might be, losing value faster, and the rates might still be 5.5 at this point. It's not a good setup, I think, whether for Asia or for the United States at this point, just in terms of the financial world. So I think this is going to be really interesting to see how this plays out over the next few days to weeks in February. It's a good chance that we could be going below this October 22 low, which means that the next low for us to find support would probably be around 2008 down here at about 10,788. So let's not get ahead of ourselves, but that's definitely something that we have to keep on our radar if we lose the October 22 lows. Now let's go into something important, which is going to be impacted tomorrow by Jay Powell, and that is the DXY. It's been relatively strong amid everything that's happened. The stock market's still rallying. There's a reason that's kind of fishy for me, that, why is the dollar strong even though the stock market is at all-time highs right now? Well, I think a lot of investors are starting to see, and maybe even some governments are starting to see, that there is a dollar shortage. We need to be acquiring this. And maybe we're wrong. Maybe everything does work out, because even though we're clueless, sometimes maybe we could be wrong about, being wrong. I think central bankers are hoping that they're right about this soft landing. I don't necessarily agree with it. Maybe this is some hedging here. Also, people were max short on the dollar, so it made sense that we get a bit of a squeeze here. We're extremely overbought on the daily, and this kind of concerns me because every time we are overbought on the fucking daily, we go into an FOMC meeting and it just tanks right after. So I think that there's two scenarios that we could potentially see, and gold and the bond market are both telling me the same thing. It's all right. They pause, but there's a high probability that they cut rates at one of the next two meetings. It's going to send the dollar straight down. It's going to send the yields straight down. That's why the yields are going up today, because people aren't necessarily sure what to do. You can take advantage of the equity market right now while the yields are, just sell them off while they're worth something. And then tomorrow they might be buying those up like crazy, depending on what Powell says. And the other thing is gold is doing something really interesting where people are kind of hedging in gold right now. But I think that might be coming to an end as well. So it's either, yes, we're going to see, cuts fairly soon, something that they didn't necessarily see, 5-6 months ago, or they have to keep policy restrictive given what's going on in the Red Sea and some other things. The labor market's still extremely strong. That wouldn't be great. That would cause the dollar to skyrocket probably a little bit more, maybe to 105. So it's really, you're pretty much on like what's that thing from Avengers when Thanos is like balancing perfectly balanced, that little knife he has? It's pretty much like that, but it's not perfectly balanced. As soon as he says something, it's going one way or the other. So it's really interesting to see how that plays out. Let's look at the bond market real quick. You can see that these yields are pretty overbought. In the overbought territories, so people have been selling these off like crazy. I think there's a good chance that we could start to see these dip down. And if he does say something about rate cuts, I have a funny feeling we're going to start seeing the long end and the short end of the curve come down significantly. I mean, the 2-year definitely needs to come down, but I think this one will probably tank a lot faster. The 5-year will tank pretty well. 10-year probably will stay relatively higher compared to the two, but I think it's still going to come down closer to that 1% range at the bottom of this market. So I think yields are definitely going to be something people are going to be wanting to get into. I don't think they're a bad idea, especially if he starts talking about like sounding dovish. But I think that there's a lot of reasons to be, wary of what's going on and why these rate cuts are coming sooner than we anticipated, right? So it'll be interesting to see if the bond market prices this in. Looks like the 10 to 2 year treasury yield, the stochastic RSI is getting close to oversold, probably oversold today. I mean, if they buy the shit out of bonds tomorrow, there's a good chance that this can get reverted back to zero in the coming 2 to 3 weeks. So something that we have to keep an eye on there. And the last thing I want to look at real quick that all has to tie in with what Paul's doing. Let me zoom in because this is absolutely crazy. But this is the Elliott wave theory of gold. I've been tracking gold like crazy lately because that impacts the dollar. We could see, I think we're in our wave 3 right now, coming to the downside for gold. We had our first 5 waves down here, and then we had our wave 2, which is this ABC. We hit the level that I was hoping. It was right around, I think today we hit 20. What is this right here? 2048. So yeah, I was expecting about 2050. So we looked up there, we got rejected. I think there's a good chance that this structure could be over with, and whatever Powell says tomorrow is definitely going to impact the price of gold. Everything is pretty much at a place where it's going to move. It's just a question of what moves and what doesn't, right? So it's going to be really interesting to see what he says. But if gold decides to tank on whatever he says, or the dollar starts to get really strong here, there's a good chance that we could be coming down to below 1900 for gold. So that's a really good move for gold that we could see. It's going to shoot the dollar up. It's going to make other currencies weaker. And it means probably the equity market's going to be selling off a bit too. So very interesting setup across the board with some of those. Not necessarily stuff that is very exciting when we look at equities and crypto, but definitely important stuff nonetheless.
I keep going back to the historical trends of when there's a rate, when they finally pivot and cut, is when we see the market correction. And month, the next meeting after this one is March 1st. So I think we still have another month of potential, upward movement in the markets. And, find your exit point, move into fixed income, lock in those rates before the correction happens. Like if, for most people, you buy and hold and you slowly accumulate, and that's fine. If you're trying to be more active in the markets, is that the play right now? And that's what my gut and my years of being involved in the markets and researching this stuff is telling me. And I think you have to, if you're trying to maximize your money, you got to make moves at sometimes. Like this is the year that we said do less, and I'm not a very active trader. I make a few trades a year normally. This feels like it should be the trade, like the big trade of the year is flipping from, risk on to fixed income and just letting things play out. Maybe it's a 6-month bond with with what I pull out there, but it feels like this is the right time based on every factor that we're seeing. The bullishness can't it's too much, right? Like I get that it's an election year. I don't particularly care. Like we've talked about, we've seen election years go to hell in a handbasket before. So all the things that people are pointing to is why it's going to be a bullish year, you can very easily disprove. Like people are just they know what narrative they want, or they know what outcome they want, and they're fitting the narrative to that, as opposed to looking at what's actually happening and what the most likely outcome is. And right now, it feels like the most likely outcome is we've rallied like a motherfucker for the last 13, 14 months, which has been great. And now it may be time to trim a little bit off there, get a little bit more conservative, try to lock in some of these better rates for a short, medium time frame, and just let things play out.
Yeah, I think I completely agree, man. I think locking in some of those guaranteed cash, safe cash, isn't a bad way to operate, especially with what we're expecting. And again, I'm just going based off of what I'm seeing in the charts, and it's. I'm gonna pull up the S&P real quick because I was looking at this last night too, right? And I was talking months ago, and I was like, the S&P could drop 50%. It could, right? It doesn't have to, but it could definitely drop that much. And if it did, what does that look like? And I think it's no different than when we looked at it maybe even a year ago, really, when we were back on the other show. I got the S&P pulled up right here, and let me just go to the monthly. So I think when we were looking at it about a year ago, it was maybe the October lows or something like that, right? Let's just say the October lows. And we were saying that it was probably going to come down to maybe 26 at the very least, which would have been right around here. So that's another 26% drop from there. And I said the worst case scenario, we go down to the COVID lows. Now, if we pull that from the top of where we were at the all-time high previous to that, and we go down to say 2,600, that's 44%. Down to COVID, that's 54%. And if we look at 2008 from the height, we go there to there, it's 57%, right? So it's a really interesting thing when you look at that and say, okay, just because we didn't get that major drop doesn't mean that it's still not there. I think we're still part of this massive structure. And again, it's really hard to see it when you're in the moment. When you're looking at this, it's like, oh, this is this is historical. So this has already happened and it looks like we're putting in another structure. It doesn't look like a lot of the stuff back then. But then you think about it back then, it's like, well, back then you didn't have any of this data where it was just going straight up forever, right? I think this 15 years from 2008 to 2023 really affects how people see the market. And I think they kind of forget that during this time, every central bank, every country was just printing massive amounts of money. That's why we rallied like a motherfucker all the way for 15 years, right? I think this is, if anything, if we're looking back in this in history, I think this 100% is our roaring 20s, 2009 all the way to 2023. And here we are today, all the way up here, not that much higher than where we were back in 2022. Like everyone's saying like all-time highs. It's like, yeah, by a little bit. It's nothing too crazy when you look at it, in the context of where we were a few years prior. It's up, let's see, we're up about 2.45% in the month in the S&P. If you look at that from where we were in 2022. What happened when we got to the all-time highs in 2022? We dropped significantly, right? We went from there all the way down to there, 25%. Now the question is, we're up considerably higher, and let's say we want to see the percentage of what it would be if we dropped to 2,600 from 49. It's about 46%. If we go down to the COVID lows, 55%. Nothing has really changed in the I can't speak. I just ruined the perfect clip. The grand scheme of things, when we look at the macro, the percentages are very minimal, the difference between them. I think that if anything, we're in the same spot we were when we were bearish at the top of 2022. So does that mean that we're going to see the same type of correction? Maybe, but I will just say this, there have been crashes in the past where, I'm not going to go to Japan right now and pull up the Nikkei, but that crash lasted 6 months and it dropped them, I believe, close to 60%. We could see a crash. Even I'll pull the .com bubble because that's a fun one, and then we can get on with crypto and then call it a day. But if you look at the .com bubble, we're all the way down here. Let's say this is the height in March of 2000, and let's say 1 year, right? 1 year, see how low we got. Let's say here to, what is this, March? No, it's right there. 1 year we dropped 68% in the tech stocks. Let's say half of that time, we could drop roughly. So what is that? March to September. Where am I? September. Somewhere around there. I don't know. It's like 27% still, but like those are pretty good moves regardless of the amount of time that's there. Things happen fast, right? This happened fast, but this happened even faster, the back half of that. So it's really interesting to see and put that into perspective. I think a lot of people are just, like you said, burying their heads in the sand and just kind of making things seem the way they want it to be, and they're positioning themselves accordingly. I think you need to prepare for both scenarios. I think you need to prepare, like you said, for another month maybe or so of pushing a little bit higher. I also think you need to be position yourself to the point where volatility could kick back and this could absolutely blow up in all of our faces, because guess what? At the end of the day, if we look at the Russell there we go. The Russell compared to some of the other indexes, we're not back where we were back in 2022. We're actually considerably lower, if not 20% lower from that. So there's definitely a disconnect. I think the narrative is also just very misleading, and maybe it's because we're in election year, but I don't buy it one bit. And if that means I have to be bearish till the very end, well, then so be it. But I think preserving capital, being safe, like you said, locking in some of those guaranteed ways of guaranteed yields. Yeah, 20-something% back in 2023. I don't think a 5% yield or 4.5% yield is a bad way to guarantee for the rest of the year. Just my opinion.
All right, let's go just quickly through anything crypto that you think is worth noting, and otherwise we can wrap this bad boy up.
Yeah, let's just pull up Bitcoin funding rates. We'll take a look at liquidations, and we can call that. Bitcoin's price is it's very interesting right now. I think that we're at a level where we're going to see either a pullback, like we mentioned yesterday, or we're going to see a little bit push higher. So let's see if we can find the answer in the funding rates. You can see that the funding rates are kind of negative across some of the exchanges. You can see Bitcoin's negative on 1, 2, 3, 4, 5. Seems like people are shorting a little bit. I don't think it's enough for it to warrant a short squeeze higher. I think that Bitcoin's also extremely overbought on the daily, and so I think there's a good chance that we could actually push down here because it's not the strongest, but maybe this could be the momentum leading into the push down for a little bit before we get another push up higher. I'm seeing a lot of people say 50,000. I don't buy that until we get above 45 or so. So we'll have to see how that plays out. It's still possible, even if the structure of an ABC corrective pattern here leads to a push higher, an extended C wave. That would be the only way I think we can get to 50,000, but we're going to see how this plays out. Let's take a look at the liquidations. Let's pull up the 7-day. We can see where a lot of liquidity rests for Bitcoin. And now, yeah, this lines up with a lot with what we were saying, right? We said there's a lot of liquidity all the way up to about 45.5, 44.5, 45. So it seems like that's all there, but look how much is built below because of Bitcoin's price shooting up, right? So down here, this is where we screw all the people that were going long. Up here is all the people who kept on shorting. So I think there's a good chance that we could wipe some of this off, maybe clear some of the table of some of these longs real quick, and then we can keep pushing up if we start to see some of these build up. I think we're in a bit of a liquidation mode right now. Question is, though, apparently, I forget who it was. Let me pull this up on Twitter real quick. I sent it to someone. It was talking about ETH pumping today against Celsius, ready to liquidate about $2 billion worth of assets on January 31st. So that might also be something to do with the price pushing up here. Let's take a look at the Bitcoin chart now to see if there's anything there, and also ETH to see if there's anything there. Let's go here. Let's go to this and zoom down to crypto. So with knowing that there's going to be more liquidations and more people shorting the market and selling supply, it's no surprise to me that the prices have stayed relatively high. But could that also be part of our corrective wave down? Possibly, right? Our wave 2 is a 3-wave move to the upside. It's extremely overbought here. We're at, let's see what it is, 100 and 100, 197. So that's a pretty good move. See where the EMAs are resting. Pulling them up. Man, my internet's really slow today. I'm not even seeing the EMAs at this point. Wow. Let me see it again. Try it again. Nah. Internet's slow. Doesn't want to work. All right. So basically, this looks like it's ready to push down. I think a lot of people are saying we're going to get a double top. I think we'd have to see if this is a bigger ABC wave. So it could be this right now, or it could be something like this. You can see something like that, very similar, like a flat correction, or it could be one with a extended wave, and that's how we would get, maybe our 50,000. But we don't have any guarantee of that yet. We need to see what happens next. I think if they do sell off Bitcoin with some of the, the Celsius liquidations, it's a good chance that we could see a pullback, and then we could see another rally higher where they maybe liquidate from higher. So it's going to be interesting looking at that for Bitcoin. I'm not surprised that ETH is actually having a pretty good day today. It's up 2.46%. It kind of plays in with that same theory of wave 1. We're in our wave 2. We need to see how high this goes before we can expect a pretty good drop to the downside. So liquidations are to be had. I think 45 right now for Bitcoin remains the top of where a lot of liquidity rests. I'm not convinced we're going to 50K unless we break that and we start to see a lot of people pile in the shorts. I think that's the only way we get to 50, but maybe I'm wrong. That's what I'm seeing on the crypto front. I think more importantly, earnings are going to be the most important thing to be watching outside of market hours today, though.
Yep. Market earnings, and not just the headline numbers, but kind of reading, the actual earnings reports and what they're forecasting and the expectations. That is going to be really crucial. We'll be back tomorrow to talk through the FOMC decision, what Jerome Powell has to say. We'll go live, shortly after Powell gets done speaking, so that we can have all the speech there and talk through that. So appreciate everybody for watching us today. If you have not yet, hit that like button, subscribe to the channel, drop a comment in there. All of that is greatly appreciated. Have a great rest of your day. Stay safe in the markets, and we'll see you tomorrow.
Take care, everyone.